you're a long-term buy and hold investor, then don't even bother with ETFs, also known as exchange-traded funds. Stay away from them. My name is Milan, and from moving to the US at age 5 to becoming a millionaire, I've learned what actually works to grow your wealth, and I share everything on my channel. I used to think that index funds and ETFs were the same thing, but after I started investing, I learned that they're not, and that ETFs lack an important feature that everyone needs in their investment portfolio. There's a big debate online when it comes to investing in index funds versus ETFs, and people mix them up all the time. So I'll talk about the pros and cons of each, why I hate ETFs and prefer index funds, and why you don't need ETFs as a passive buy and hold investor. Let's get started with index funds. So to give you a full understanding of index funds, I need to explain mutual funds as well, because all the benefits from mutual funds carry over to index funds. So I'm going to talk about all that right now so you have a full understanding of how they work, which will allow you to make the best decision for you. Mutual funds came way before index funds and ETFs, and the first ones came about in the 1800s. They allowed people to pool their money and make investments together to get more benefits. There were three major benefits that came out of this. First one being convenience. Before mutual funds were around, if you wanted to invest in multiple companies, you would have to do it yourself. Let's say you wanted to invest in the top 500 companies in the US, you'd have to buy into each of those 500 companies individually. So you would have to research all these companies and sit there on the computer and buy each single one to create your diversified portfolio. It was very time consuming and people just didn't have the skills to do it. Instead of having to go out and buy hundreds of stocks in different companies yourself, you could actually just buy one mutual fund. Mutual funds have hundreds of different stocks in them, but all you have to do is make one purchase. You would get instant ownership over all the different stocks and companies that the mutual fund owns. Now, why would you want to own a bunch of these different companies at once? Because of the second major benefit of owning mutual funds, which is diversification. Diversification is a way to lower your risk by spreading out your money into a bunch of different companies. Instead of putting all your money in one stock, you now have your money in a bunch of different stocks. So if one stock crashes, you're perfectly fine because you still have a bunch of others that your money is in. But if you had all your money in one stock and then that stock crashes, then you're done. You've lost all your money. The third benefit is these funds are usually managed by a professional team. So instead of doing all the technical or the fundamental analysis on your own, you are basically paying somebody to do this for you. So you get all those benefits: convenience, it saves you time, diversification, and access to money professionals. Convenience and diversification are great, but there is a huge downside with mutual funds that cost people hundreds of thousands of dollars. The downside actually goes hand in hand with the third benefit. The problem is these super smart people charge a lot of money. When you have a team of professionals picking the stocks in a fund, that is called active management. So they'll manage the fund, they'll do the fundamental and technical analysis and choose the stocks, but they charge a 1 to 2% fee over your account balance every year. So if you invested $100,000 with 2% fees, that's $2,000 charged to you every year. The cost of fees can really add up. Imagine that $2,000 in fees you were paying on your $100,000 portfolio compounded over the next 5, 10, 15, 20 years. It ends up being hundreds of thousands of dollars for some people. So it can really cut down your portfolio by a lot if you don't pay attention to these fees. And this is regardless of the performance of the mutual fund. Even if it does bad, even if you lose money that year, then the manager still gets paid from your balance. So you can end up with less money while the fund manager still gets hundreds of thousands or millions of dollars in their pocket for making wise decisions. Which is why most mutual funds are just not worth it. And that's exactly why index funds were created by Jack Bogle, the founder of Vanguard. He created a whole new category of mutual funds that were passively managed called index funds. These completely revolutionized investing. Unlike regular actively managed mutual funds, index funds are passively managed. This means that instead of paying a professional person to do the fund management, it just follows a formula and tracks an index, which is why it's called an index fund. And that's how you get all the benefits of a typical mutual fund without paying the high fees. Because instead of paying a fund manager to actively manage for you, the index just tracks a group of stocks, which eliminates the need to have somebody make buying and selling decisions. To keep it simple, think of an index as a tool to quickly measure the performance of a group of stocks. So it tries to match the returns to that specific segment it's tracking. For example, the S&P 500 index tracks the top 500 companies in the US. An S&P 500 index fund would just buy all the companies in the S&P 500 index, which are the top 500 companies in the US. And that's why the fees are so much lower, because you're not paying a person to do this. This is automatic. There's also the total stock market index, which includes all of the companies being traded in the United States. And the fees for index funds are as low as 0.03% over the actively managed 1 to 2% fees. So huge difference, they're a lot lower. VTSAX, which is the Vanguard Total Stock Market Index, and VFIAX, which is the Vanguard S&P 500 Index, have really low expense ratios of 0.04%. On $100,000 portfolio, that's only $40 annually. So that's how index funds work. So to recap, we just talked about mutual funds, which is how index funds came about. The big problem with mutual funds were that they had really high fees. Hence, Jack Bogle created index funds, which solved that problem, but allowed you to get all the benefits of mutual funds. Now let's talk about ETFs, also known as exchange traded funds. ETFs ETFs were introduced not too long after index funds. Just like index funds, they provide convenience and diversification. VTI, the Vanguard Total Stock Market Index ETF, tracks the total stock market index just like the index fund VTSAX. VOO, the Vanguard S&P 500 Index ETF, tracks the S&P 500 stock market index just like VFIAX. And just like index funds, they have really affordable fees for as low as 0.03%. VTSAX and VFIAX actually have an expense ratio of 0.04%, so in some cases, index fund fees can actually be higher. But they still do have key differences, which is why I prefer index funds. One major difference is that with index funds, you can only buy and sell shares once a day, at the end of the day. So that's why a lot of people will use ETFs and index funds interchangeably, but they're not the same thing. With ETFs, you can buy and sell your shares whenever the stock market is open. ETFs trade just like a regular stock. Just like a regular stock, the price of an ETF will fluctuate throughout the day when the market is open. You'll basically see all the same variables that you see with a individual stock with an ETF. That means that an ETF gives you the ability to be able to time your purchase, short it, buy and sell options on it. Basically all the things you can do with an individual stock. You can't do that with index funds. So you're getting more things with an ETF, but that's not necessarily a good thing. Long-term buy and hold investors do not need these additional features. The average person that just wants to invest and just wants to hold it for a long time is not trying to time the market or selling options on it. They would not even think about doing that. Simplicity is the name of the game when it comes to long-term investing, and all you need is a good low-cost index fund for that. You don't need all these extra features. The question you need to ask yourself is that, do you need the tradability that comes with the stock market being open? Now, here's why I hate ETFs for long-term investors and why I prefer index funds for the buy and hold strategy. So because it can be traded just like a stock, the problem with that is you can watch your ETF price go up and down on a chart, which encourages impulsive buying and selling. And that's not good for the long term. And we are human, we do have emotions. It can be really hard to control ourselves when we see those changes. We might want to cash out or we might want to sell, which is obviously the opposite of smart long-term investing, because time in the market always beats trying to time the market. But even though people know that, people still can't control their emotions. So that's why I hate ETFs and prefer index funds, because over the long term, ETFs do more harm than good for the average person. We want to remove that added temptation. We want to remove any variables that might stop us from making good long-term returns. One final reason why I like index funds over ETFs is because it saves me time. Index funds offer automatic reinvesting. This feature lets you automate your investing. You can basically set up monthly recurring deposits and it'll automatically buy shares of index funds for you every month. So without doing anything, you can have $100, $200, $500 being invested into index funds every single month. And this is great because instead of you having to waste time and log onto your computer and have to buy your stocks every single month, you can completely automate it. I don't want to have to wake up early on Monday to put in a buy order, calculate how many shares I can buy based on the price fluctuations, which could potentially even change my mind. And I could think to myself, you know what, maybe the market's going to go lower tomorrow, so I'll buy tomorrow. I prefer to spend that time making more money. Whether I'm working or spending time with my family, my money is being invested without me even realizing it. Without having to do anything, investing is now a habit for you because it's automatically happening. How cool is that? You can't set up automatic investments with ETFs. If you wanted to put more money in your ETFs, you would have to do that manually. That's just more work that most people don't want to do. It also means more commissions every time that you trade. Now, there is one good thing about ETFs, which I'll mention here, and that is that they don't require minimum investments. Index funds typically require a minimum amount of cash for you to be able to invest in them. In the case of the Vanguard Total Stock Market Index Fund, it is $3,000. VTI, on the other hand, has no minimums, which means you can invest for as little as $1 in them through fractional shares. And that's why ETFs can be great for beginners that don't have that much money to start investing. But I think it's a better strategy to move to index funds over the long term so that you can automate your investing and get some of these other key benefits that come from index funds, primarily the psychological one of you not being able to see the price go up and down every single day and impulsively selling and getting out of the market when you should have just stayed in. Those are just my thoughts. Big picture, you really can't go wrong with other ETFs or index funds, because if you're saving and investing anything at all, you're already winning. You're already ahead of 99% of people. ETFs are great for beginners because of that no minimum and being able to start with as little as $1, but index funds are best for serious long-term buy and hold investors, which has been proven to be the best investing strategy and how a lot of really wealthy people built their wealth. And it's also what Warren Buffett recommends for the average person. So as a recap, mutual funds came first and then index funds came, which gave people all the benefits of the actively managed mutual funds, but without the fees. And then came the ETFs, which trade just like a stock and offer almost all the benefits of index funds. Now, if you still haven't started investing yet, then check out this video on how to start investing as a beginner. I truly appreciate every single one of you watching. Good luck and have an incredible day.